everyone, I'm Amisha CPA and welcome to my channel. My goal is to share my knowledge to help people lower their tax liabilities legally and make the right financial decisions. Today we are going to talk about the tax strategies in sale of rental real estate investments and understanding of capital loss versus passive loss. The real estate market is pretty good at the moment and it's a seller's market. You may be thinking of selling your highly appreciated real estate investments, but what about the tax liabilities? How much of your capital gains would you lose? There is a high probability that capital gain tax rate will increase in the near future. We still don't know a precise date or even have 100% certainty that capital gains hikes will be enacted. But if it does, then high earners will be looking at nearly 44% in federal capital gain taxes, and this doesn't even include any state tax. So the simple strategy can be to accelerate the sale of capital asset to trigger and lock in the lower capital gain tax rate if you're already thinking of selling in the next few years. Let's take a quick look at the standard long-term capital tax rates, not including any state taxes. If you hold your assets for more than 1 year, then you can take an advantage of long-term capital gain tax rates. If you're filing a married joint return and your income is less than $80,000, then you won't pay any long-term capital gain taxes. If you're filing married joint return and your income is between $80,000 and almost $500,000, then you pay only 15% in long-term capital gain taxes, and over $500,000 of income you pay 20% in long-term capital gain taxes. For individuals, filing single tax returns have different income limits as per this chart. If rates go up, then you can assume there will be a crazy rush to sell highly appreciated assets by the end of this year. Now, to further offset your gains, you should review your past year's tax return and see how much accumulated capital loss and passive loss you have carried forward to your 2021 tax return. But let's understand the basics of capital loss and passive loss first. Now, capital loss is a loss that is typically generated from any sale of a business, sale of a real estate, sale of stocks, etc. If you have sold for less than your cost basis, then you generate a capital loss. You can deduct only up to $3,000 of net capital loss annually, and the rest you can carry it over for unlimited number of years until it's exhausted. So before selling your real estate investment with gains, see how much carried over unused capital loss you have that you can offset against your capital gains. Let's say you're holding investments with a loss such as mutual funds, stocks, and you haven't decided whether or not to sell. I would advise you to sell those at a loss either before or during the same year you plan on selling your rental real estate that has capital gains. By doing so, you can offset more capital loss against your capital gains. Now, a passive loss is a net operating loss from day-to-day rental real estate activities that you have not claimed against your ordinary income and carried forward the losses year after year. Even if you have net income from your rental real estate, you could have reported a loss due to depreciation expenses and accumulated those suspended passive losses on your tax returns. If you sell your rental real estate, then the accumulated passive losses of the property can be claimed against your ordinary income in the year of sale. By doing so, you can reduce your ordinary income as well. And this concludes some of our tax planning strategies on sale of rental real estate. If you like this video, don't forget to like and subscribe. Stay tuned for more videos on year-end planning and tax updates. Thank you so much for watching and see you soon.